Welcome to the June 10th, 2019 Advance Report for McGowanGroup clients and NetWorthRadio.com listeners. I'm Spencer McGowan, your financial weatherman, president, McGowanGroup Asset Management down at the Crescent in Dallas. We're glad you've joined us for the fast-paced tour of the global financial markets. What a week! And what a week of shifting perspective from just 6 months ago. So let's first look at the Dow Jones Industrial Average, range-bound by our measure. This is a 2-year chart. And what you could see is that beginning 18 correction, the Christmas correction, the recent correction down to 24,800. This week, at the end of the week, the Dow spiked over 26,000, a 1,200-point rally from just about a week ago. What happened? Well, some of this has to do with Federal Reserve Chairman Jerome Powell. You see, he came out and said, we're actually considering a cut of interest rates. We're going to look at that in a second. Part of the reason is this chart. 3-year chart, and what we have here is the T-bill rate for 90 days. Then we have the other treasuries at 2 years, 5 years, 10 years. So the pink one is the 10-year. I'm going to key on that pink one, the 2 and the 5, of course, related. But notice all of these longer yields are below the short rate that you could get. You get more for 90 days than you could get 2, 5, 10 years. That makes no sense. The world's upside down. It's called an inversion, and it's preceded recessions. So the Wall Street superstition helped to sell the market off last week. The rally this week, Federal Reserve Chairman Jerome Powell said, hey, the world's upside down. We may actually cut rates if we need to. And he cited, of course, the trade negotiations or trade wars, depending on which side of the aisle you're on. Here we go. Federal Reserve probability that they'll actually cut the rate. Now, a rate cut, this is where we are right now. There's a cut. So 59% likely in the July meeting. There's a June meeting, the announcement on the 19th. It's a 1 in 4 chance they'll cut. Here, well, 59% likely that they'll actually trim that short rate back. Wow, what a surprise. Because remember last December, the Fed's going to keep raising rates all of 2019. We're probably going to have a recession. We got a global slowdown, but the Fed's not going to stop. Well, the Fed just stopped and may even cut. Whole different interest rate picture from 6 months ago, and potentially a different market picture. Congratulations to the United States of America. This is energy consumption and production. It's a chart that I'd like to highlight because in 2018, notice the U.S. uses, okay, this is not in oil, this is in oil and natural gas, basically all the energy consumption and production. 100 quadrillion British thermal units. That sounds like a lot. So the production, notice, is just below it. This graph is on track for 2019 to be, congratulations to the Texas Black Gold Rush and Shale Revolution, the U.S. energy independence for the first time in decades. Wow. And you can see natural gas production, this yellow line, is the secret driving that. Natural gas liquids and also liquid natural gas exportation contributing to that. But it's highly likely these two cross this year based on that chart. We will alert you as soon as we get the real data from the EIA. Now, how do you take advantage of a great trend like that? And that's part of the reason that inflation's low and rates are low, right? You're not going to have high inflation if you have an energy shortage and you're sending billions of dollars to Saudi Arabia. Here we go. Now, let's take a quick look. Next chart. Here we go. What we're doing right here is just oil prices. Whoa, look at that. 66 to 51, lickety split. Well, part of that's more production from the Permian Basin and other successful oil and gas exploration. Now, we can see last year, 77, about 77 at the high. Whoa, we go to 42 really quick. Then we go to 66. This looks also range bound for a while. How do you invest in that? Because if oil goes down, then it's harder for the oil companies to make money, right? Well, Energy infrastructure could be the key there. I want to highlight the experience in 3 energy companies that are considered exploration and production, but they own a lot of infrastructure. What's intriguing is that it's dividend dependent on the long-term total return. What I mean is, you didn't make very much money, and in these 2, Exxon and Oxy, you would have lost money over the 12 years. Wow. And you made a little bit of money with your dividends. Well, higher dividends are likely to be worth more when the treasuries are just paying 2%. 7% or 6% from a dividend, heck of a lot better than 2% from a treasury longer term, even though you're going to have some price risk in there. The price risk may be positive because all that energy flows, a lot of it, most of it, flows through pipes. And if you own the energy infrastructure, you get a bigger dividend than these 3, and you may have more appreciation potential because throughput is like a tollway, what they get paid on. That's why we've been focused on that category. But I do want to go through the cycle here and how it impacted. Icon, a shareholder in Oxy, came out and said, I don't like the deal. Warren Buffett loves the deal, put in $10 billion for Occidental to buy Anadarko. Clearly, these companies need to change because these 2 have negative price depreciation over 12 years. They only made 2% even with the dividend. Look at Anadarko, 41. That's 51% better return than sitting around in Exxon and Oxy. Why? I would argue exploration and production talent, plus Anadarko has vital infrastructure on the Gulf and the other oil basins. Now, if we look at that, well, Anadarko did closer to 4%. It's still not a great 12-year return, but it's a heck of a lot better than the others, showing talent, and that's an interesting development in the energy markets, also likely to benefit from the U.S. moving towards net exportation, even with still importing millions of barrels of crude on a daily basis. Natural gas puts us energy independent. Congratulations, USA. We'll report that as soon as it happens right here on my YouTube channel. YouTube, McGowan Group, subscribe, and when we get important breaking financial news, boom, you'll get an alert. Join us each week, fast-paced, educational charts and graphs that you just won't get anywhere else, and an education that I believe makes you a better investor. My firm, McGowanGroup Asset Management, sponsors NetWorthRadio.com and, of course, our YouTube channel under McGowan Group. Some educational disclosures and discussions that I wanted to add to the broadcast. The first is, I'm very proud of our team, including Stephen Norris, who will be added as soon as we redo the picture. He's our newest team member. Come down, meet the team that cares, get a written plan, because the securities we discuss, the financial news we discuss, that's not a recommendation until you actually come down and get a customized plan at the Crescent. You'll get a tour, and we look forward to seeing you. We're going to cover value at risk of loss in portfolios, and you can see it right here. Learn about our performance, what happened in 2008, how long did it take to recover. All of those items are posted right here at NetWorthRadio.com or the McGowanGroup.com. The other part of the program, when we look at price fluctuations in bear markets and risk control, that's a huge part of NetWorthRadio.com. We look forward to helping you advance your plan and your cash flow. Come down and meet the team that cares.